Good evening. For the DPP Grain Desk, this is Duane Lowry on Sunday, January 30th. The outlook tonight I find kind of mixed. We have the fiscal cliff discussions going on, which I think are basically going to somehow come up with some sort of a conclusion. Even if it goes into the first few days of January and they make it retroactive, they're going to come up with a solution. Whether it's really a solution or a kick the can down the road type of thing, I think we all know it's basically a kick the can down the road. They're not going to really accomplish anything of any real substance addressing the deficit or the taxes or anything else. So, I don't think there's a lot of hope for that, but I think the realistic view on that is such that whatever deal is done and we avert the sharp increase in tax rates for everyone, I think that you're going to find some sort of sense of comfort or confidence in that as a knee-jerk reaction, and probably be a recovery of the stock market, a supportive reaction to the crude oil, things of this nature. As far as the impact on the grains, I don't really think there is one there unless it's psychological. And if you look at how the grain markets have traded over the last 30 days on this fiscal cliff, consideration, there's been no consistent day-to-day reaction. It's more of a nobody cares type of thing. But there could be some knee-jerk supportive reaction develop. And in the case of like stocks and crude, I think you're looking at something that is supportive for a week, but not a long-term supportive thing. I think the longer-term outlook is much more concerning to both stocks and like crude oil. But in terms of over the next several days, could we start the new year out with a supportive tone to crude and stocks? I think that's very possible, but I don't think it lasts very long. And I think that looking down the road over the next several weeks, few months, I think there's probably some troubles ahead for those type of markets. But as far as the grains are concerned, I don't think there's a big impact there. As far as weather is concerned, I strongly believe and have stated several times over the last month or more that there's absolutely no connection between day-to-day weather forecasts and midday changes and any connection at all to intraday price swings or day-to-day price swings. There just is absolutely no connection. To a large extent, there hasn't been any connection between price action and news developments here, at least for 30 days. And part of that you can blame on end of the year oddities of trying to even up positions and things of this nature and the influences that has on the price discovery process. You can blame it on holiday trade, year-end positioning, anything you want, but there's really no connection. And we're just about done with this holiday trade. We get into next week. A week from now, we'll be looking at more of a full trading type of atmosphere, and maybe some of these more traditional things that we look to for guidance, maybe they'll have some influence. But right now, we're still stuck in this meandering year-end holiday trading, and there's really not a connection. So I don't think weather's a factor. I don't think there's any news of any significance that is a factor. But in a broad sense, the weather from a South American perspective is generally favorable and acceptable. I don't think you got any major concerns about production there. You might have some areas in parts of the northeastern Brazil that are impacted by dryness, but you got other areas that are in good shape, and overall production levels are going to be seen as pretty high. And I don't think there's a drastic change there. When you look at other fundamental factors, the significant fundamental developments that have transpired in the last 30 days, I think number one is U.S. wheat has become competitive in the global pricing structure. Now you've got U.S. wheat, the cheapest wheat is cheaper than even Indian wheat. And so if there's business to be had, they're going to look to U.S. shores. I think that's been a big change for wheat prices, U.S. wheat futures, and that makes U.S. wheat futures cheap. And I think by many standards of measurement, they're too cheap. When you look at the fundamental developments for wheat, what's ahead of us over the next few months, we're going to continue to have concerns about dryness in the plains. The drought monitor map, there's not going to be any improvement there. Traders are going to have to contend with how poor the U.S. hard red winter wheat crop went into dormancy, the lack of moisture that's probably going to be the case through much of the winter, and an outlook for spring about when is this moisture situation going to improve. So it would seem to me that with U.S. wheat futures on it having had a significant tumble, getting the specs short, getting U.S. wheat competitive on a fundamental perspective, and that these other backdrops here, and the global wheat, getting tighter. Not that it's an super alarming tightness situation, but it certainly is something that is worth watching. Technical conditions are oversold. Wheat's competitive, from a fundamental perspective. I think that the wheat market has the brightest short-term upside outlook, or maybe said a different way, the most believable fundamental storyline that you can get. If you look at wheat from an intermarket spread relationship, it looks like it's not going to get a whole lot cheaper in relationship to other commodities, and it may have plenty of room to gain on other commodities. So I think that's bullish wheat. So I think you can have a positive outlook on wheat, and I think you can build a fundamental case and a technical case to support those ideas. If you look at the corn market, the price slide that we've had in the last 30 days, basically, breaking out of the previous bottom side of a trading range, and now finding values 40 or 50 cents below those levels. I think that you look ahead to U.S. corn supply and demand, carry-out levels. U.S. stocks are going to be extremely tight. Granted, U.S. exports have been poor, and some will argue that that's going to stay the case. Others will argue that there's a better chance for improving export demand down the road. I think to some extent that both of those are valid arguments, but in the January 11th, USDA is going to come out with give us an update on first quarter corn usage stocks at the time, and I think there's a better than even chance that we're going to come out of that saying, wait a minute, maybe our corn usage rates in the first quarter have been a little bit too aggressive. Maybe the price discovery process has a job to do in trying to ration corn demand. I think you're also going to find that some of the competing sources for global corn are going to become taxed either in supply or in logistics, and I think that increases the chances that U.S. corn becomes competitive in the export arena. But the biggest thing that's going to happen for U.S. corn to be able to be exported is we got to get cash, physical U.S. Corn supplies into the export pipeline. And the cash market structure domestically really hasn't been doing that at any time since harvest. So I think that that's got to happen. So one way that could happen is for the futures market to have a pretty strong aggressive rally, basis values weaken, new farmer sales, and in that type of structure, that new sales would get pushed into the export pipeline, not so much just domestic consumption. And I think that might be, a good reason for the futures market to rally, or a benefit of a futures market rally if we are able to get that to transpire here over the next 3 months. I don't think that's unreasonable. I think also looking ahead, the U.S. The marketplace is going to look at U.S. subsoil moisture and soil moisture profiles in the Midwest, the Western Midwest, the Plains states, and I think there's some concern there, and I think that's going to add an opportunity to add some what-if premiums. So when you look at how much the corn market is broken, where it's at in relationship to where it's been for the last 3 or 4 months, I think it's not unreasonable to come to the conclusion that U.S. corn futures prices are just too cheap. And I think it's going to be difficult to build downside momentum here. And I think you can build the same argument coming at it from a technical perspective, having the market having a flush going into year-end. A lot of liquidation has taken place. The Commitment of Traders report on Friday showed an even larger chunk of speculative sales, positions liquidated. And so I think you got a technical reason to think that you've got limited downside here as well. So I think the corn outlook is bright, and I think the previous things we talked about in wheat helps to build a supportive case for corn as well. As far as soybeans are concerned, from a short-term perspective, that market appears maybe a little more vulnerable to some sort of further technical selling, liquidation pressures, whatever you want to call it. And I think that over the next, let's say going into that January report, I think there's risk of soybeans acting poorly. I think that after we get the January production numbers, we might see U.S. supplies outlook is tight, but we're probably going to be reminded of an overall abundant supply in South America. So we might have even some carryover, generally non-bullish, bearish type of fundamental profile even after that January 11th report. So I think you can build a case fundamentally that maybe the soybean market is a little heavy here for the next week or two. I think you can also build that case technically. I think technical signals are somewhat mixed here. But to say that we're not vulnerable to additional liquidation pressures in the bean market, I think would be naive, and it would probably be wrong. As far as how much downside potential, I'd like to say the beans are within a dime of major support, and we could somehow hold here and turn around to the upside. When I look at wheat and corn, I'm encouraged to want to say that about beans. But if I look at beans on their own from a technical perspective, I think there's maybe a little bit more risk there, and maybe a deeper flush, and so I have some concern there. I think if somebody wants to be a bull going into the new year, I think he's probably better. It's easier for him to come up with a confident stance of a bullish position in wheat and or corn than it is in soybeans for the time being. There's also probably a legitimate bullish case for argument for beans at some point in time. Even though you have this large South American crop, you're going to have logistics problems, and there's a good chance some demand is going to come back to the U.S., and I think there's a storyline there. But when does that start, and could that start from lower levels than we are right now? I think that's possible. So as far as tonight is concerned, I think you're going to have mixed opinions. I think there's a chance that we see everything trade on both sides. I think wheat's going to be well supported, just a few cents below where we finished Friday. I think the same argument can be made about corn. In the case of beans, I think there's a little bit more vulnerability there. So look for some trade on both sides, but look for wheat and corn to be well supported. But I do have some concerns here about beans here over the next week or two. For the DPP Grain Desk, this has been Duane Lowry. Thank you.